Marco, it's really good to see you again. I trust you're keeping well in these COVID times.
Yes, Randy. Yes, I'm doing well. How about yourself?
Very good, thanks. Very good. How are things? Let me just start off by asking that. How are things in the Dominican Republic?
Things in the Dominican Republic are doing well. Obviously, we're hit by the pandemic, but before that, we were on track to be one of the fastest growing economies in Latin America. The pandemic slowed us down, but now we're kind of projected to be kind of the front runners as to the countries or economies that are going to rebound the quickest within Latin America.
Well, that's fantastic news. That's just fantastic news on the economy. So a fast-growing economy. So that must mean that you're keeping busy. Tell me, when you talk to clients, then what are the things that you're talking about the most these days?
Yeah, a lot of clients are asking if there's going to be a tax reform. We have a new president that came in August 20 last year, and he's pro-business and he's trying to promote exports, trying to attract foreign direct investment. He's trying to make, he's aware of the changing, evolving supply chains, and he wants the Dominican Republic to play in that game. So I think they're making some interesting moves. And I think they've been saying that there should be a tax reform coming this next year. So we're expecting a reform. Not going to be a major reform, but it should have some significant changes regarding the tax rate and increasing the tax base.
Interesting. And so mindful of that, I mean, you must have clients that are both, successful and currently not successful because of, the COVID situation. Do you talk about different things with those categories of clients, or what's the general themes?
Yeah, Ronnie, you hit it right on the head. I think we have clients in two buckets. We have the profitable companies and the not so profitable companies. The companies that are not so profitable tend to have some issues that are created by some inefficiencies. For example, if you generate losses in the Dominican Republic, you can't carry the loss back. You have to carry it forward, but it's limited to 20% of the NOL. So for example, if you get a loss of 100, even though you generate an income of 100 in the following year, you can only use 20%. So you could have that 100. And then in the last 4th and 5th year, you're further limited to 70% of the taxable income in the 5th year and 80% of the taxable income in the 4th year. So there's some limitations you have to take into account. And another issue that we see with companies that are not so profitable is that you're subject to a minimum tax called an asset tax. The asset tax applies whenever the asset tax is greater than the corporate income tax. The corporate income tax rate is 27%, and the asset tax is 1% of your assets. So if you look at it, like what the asset tax is trying to do is trying to generate a deemed profit of about 4%. So when you multiply it times 27%, it's like that 1%. So your assets need to be generating at least that 4% of profit, deemed profit, so that the asset tax does not apply.
So that's a really interesting one, because I can imagine that might surprise some folk who haven't been paying attention, right? They could be loss making, but they may still have a cash tax liability under the asset tax regime.
Correct. Right. And for like U.S. companies and for foreign multinationals, the asset tax is maybe not a creditable tax because it's income. And I know that some interesting book issues where it's not an income tax, then you don't have deferred tax assets associated with those. So plus, if it is an income tax, it obviously increases your effective rate when you have very little profits and you're still subject to tax on assets. And something that you could do to minimize it, and that companies are not aware of it because they're not accustomed to seeing that type of tax applied. So for example, company A that has $100 and B that has 0 assets and C that has 0, you have $100 of assets in the group. But if you take that $100 and you lend it to B, and then B during the year lends it to C, you have all of a sudden $300 of assets sitting in A, 100 sitting in B, 100 sitting in C. So we try to make sure that clients are aware of that situation, and if so, try to unwind it before the asset tax applies.
That's fascinating, because that would truly be an unwelcome surprise for many multinational businesses. What other things do you talk about with the not so profitable companies?
Well, probably with the profitable companies, it's more the interest expense limitation. Interest expense is subject to several restrictions or several hurdles. For example, you have to first comply with transfer pricing. Then you have to comply with thin cap, which 3-to-1. Then the last hurdle, one of the hurdles that you have to comply with, is you have to look at the lender's rate, the foreign lender's rate. So the lender's rate is 27% or more, you get to deduct 100% of your interest expense. But if it's less than 27%, then you take a proportion of that interest expense of the related to the rate of the foreign lender. So the foreign lender's rate is, let's say, 18%. And the Dominican rate is 27%, then you get to deduct 66% of your interest expense. And that's obviously important for like US multinationals or companies where the rate all of a sudden increased from 28 to 21. Then all of a sudden you had a haircut just because of the fact that the rate decreased. If the rate goes back up to 28%, then you're not going to be subject to that limitation. So you have to take into mind those types of situations.
That's an interesting point, because that really then comes down to a modeling exercise about like, what do you want to do with your capital structure, debt versus equity, and how much debt up to the limitations, right?
Right, and it's important. That's an important point, Ronnie, because the rate in the Dominican Republic is 27%, but the interest expense withholding rate is 10%. So it obviously allows for some efficiencies if you could do it, but you have to plan it such that you're not subject to that limitation.
Fascinating.
Another area of interest for companies that are profitable is that the Dominican Republic has numerous trade incentives or numerous tax incentives. So, for example, we have a free trade zone incentive. We have a for tourism, have an incentive for film industry, etc. So there's several strategic sectors that are subject to incentives, but a lot of our companies are not aware that the Dominican Republic offers those incentives. So, for example, you're shifting your supply chain. You had operations in China or somewhere else, and you want to now be near shore, closer to where your customer base is. The Dominican Republic is not that far away and centrally located, and it offers a possibility for companies to have a tax holiday for a 15-year period and not pay any corporate income tax, provided those sales are destined for the foreign market. If they're destined for the domestic market, they're subject to 3.5% rate on the sales, but still that could be attractive for some companies that are very profitable. They manufacture goods.
You know, that's a really interesting point, because certainly the pandemic stretched people's supply chains, and I am aware that a lot of folk are sort of rethinking their supply chain strategy and perhaps shrinking the supply chain so as to get manufacturing capacity closer to where the marketplace is. So that's a really interesting point. That's got to explain in part, I guess, why the Dominican Republic is projected to be one of the faster growing regions in the South and Central America region.
Yes, correct. And one last point, Ronnie, I wanted to kind of make sure that companies are aware of is that there's things that could apply to situations where you're in both buckets, whether you're profitable or not so profitable. So, for example, the Dominican Republic has indirect share transfers, which is hot in the region. You see Chile and Peru and other countries now implement that type of structure. So it's important if you're selling, obviously, if you're selling your company, but if you're moving boxes because you want to be more efficient and the Dominican Republic is under some of the boxes that you're moving upstairs, up the chain, then you could trigger Dominican tax without you knowing. And it's possible to get a ruling in the Dominican Republic to treat it as a tax-free org, but you have to get permission before you pull the trigger and start moving boxes. So just be careful with that.
So that's that's a trap for the unwary, right? I mean, because a lot of people focus on the top tier, the direct transfer, and people know about some of the bigger countries that have indirect transfers, tax obligations, but certainly this is one to keep a focus on as well. Because a lot of people, again, with COVID, have been looking to simplify and rationalize their legal entity footprint.
Correct.
Really interesting, Marco. Well, gosh, so one of the faster growing economies, lots of export incentives and items that will encourage domestic capacity build out, traps for the unwary in terms of financing and indirect transfer. Just a lot of stuff going on in the Dominican Republic these days.
Yes, you hit it right on the head again, Rodney.
Look, it's really good to catch up with you. It's good to see you again, Marco, and it's good to see that you're keeping well. Stay healthy, okay?
And to you, Rodney. Thank you very much for the opportunity to speak to your audience.